What have you been looking at, Steve, earnings-wise?
So earnings for me, I thought I would have a quick look at Intuit. So this was an interesting report. They reported on Tuesday, and at face value, this looked pretty awful. Gross margin, operating margin, net margin all fell, and that led to less free cash flow, less net income. In fact, both of these were nearly down 50% in the quarter year-on-year comparisons. But the next day, the stock went up 6%. So here's why. Last year, due to the plague, Americans were allowed to defer filing their taxes for about 3 to 6 months. Some of them had a little bit longer because they also had a storm. So this meant that filing should have been done in April, i.e. the quarter before this quarter, if that makes sense. So bumper period for Intuit the quarter before. As I think we reported when it came in, they make a significant amount of their money through their TurboTax products when it comes to yearly filings. So reverting back to the old dates meant that we can't compare year-on-year quarters because they're just not like for like anymore. And this also explains why the last quarter looked so incredible and we thought it was great. In terms of consensus, they beat on revenues, they beat on service revenues, beat on small business revenues, beat on Credit Karma, missed on consumer revenues, beat on operating income, beat on operating margin, beat on adjusted EPS, and sort of 28% miss on cash from operations, which was quite an interesting dip. In terms of segments, QuickBooks grew 34%, online services grew 116%, although this includes MailChimp, which is a recent acquisition. Without it, it grew about 29%. International revenue tripled, but you've got to understand, again, this is MailChimp again. TurboTax grew about 1% for the reasons described earlier, and Credit Karma grew about 17%. In the quarter, they bought back about $2 billion worth of shares. They've got on authorization to purchase another $3.5 billion. They boosted the dividend by about 15%. So looking pretty shareholder friendly to me, but not that friendly because they issued a lot of shares when they were buying MailChimp and integrating MailChimp. So whilst this softens dilution, shares outstanding actually still managed to go up by about 3% year over year. Forward guidance, Steve, I'll just give you that quickly. Was good for the next quarter, expecting revenue growth of about 24%, EPS growth of about 23%. Both of these was just slightly under Wall Street's expectations. For the full year, they're expecting growth of 15% on revenue and about 16% on earnings per share. Both of these actually beat Wall Street expectations, creeping up to about $15 billion in revenues. So this one's getting towards the law of big numbers for growth, combined with, they think they're going to have some pretty muted expectations for Credit Karma with the potential recession headwinds. I think credit is looking a bit sticky going forward. But what do you think, Steve?
That credit space is interesting, isn't it, with interest rates going up. I'm never quite sure what to make of that. On the one hand, I feel like demand for mortgages, loans, all those kind of credit-y types of products is going to be lower as they get basically more expensive, so that makes sense to me. I own Experian in this kind of space. But I also kind of think, well, in that situation, people are going to want to be a bit more careful as well, and therefore looking, maybe stuff like Intuit does all right in this sort of situation. I'll take your point about the kind of, yeah, you put it as law of large numbers. I guess I was thinking of kind of growth runway, the horizon coming into view a little bit. That's what you expect from companies that are buying back stocks and distributing dividends and stuff, right?
Starting to mature. I think the growth from here is going to be incremental growth on those products that we discussed earlier. And then I think they just keep tacking on new businesses when they find something that they actually like. And I'm surprised at the moment that they're being so shareholder friendly, because all the sort of software business that a software conglomerate would want to bring under its wing have got quite considerably cheaper in the last year or so.
Yeah, I was sort of thinking that as well, looking around and looking at quite a lot of these, many of which I don't feel particularly qualified to distinguish good from bad with. But it does seem like an interesting time for a company with cash available to kind of be acquisitive. With paying a dividend, do you think that gets in the way of things? That there's now an expectation on a dividend that didn't ought to be there?
Yes and no, but they've been paying this dividend for 8 years and it's still only about 0.5%. So I think it's sort of a distraction, I guess. It's just a way that they're trying to just differentiate themselves, I guess, a little bit. And hey, look, we're really shareholder friendly. We're doing both of these things. But at the sort of stage Intuit's at, I lean towards wanting them to go and look for opportunities rather than give me the money. I'm sure they can do a better job with it. They've proven that on a number of occasions.
I think that's the right way to think about things for what it's worth. I mean, I mentioned earlier the one thing I don't like about Amazon. Here's the one thing I don't really like about Berkshire Hathaway for what it's worth. They have a policy regarding dividends of saying, look, if we think we can turn $1 into more than $1, we should keep it, rather than distributing it to you as $1. I don't think that's the right metric to use. I think it's the way to do it is say, look, if we think we can grow this better than you can grow it, we should keep it. That may be turning it into more than $1. It might be that I can compound it better than they can, partly because I'm a smaller operation and therefore have a wider universe available to me. One of the things we hear a lot from Berkshire is, size makes it different to find things that are able to move the needle and so on. So I'm not sure the $1 for $1 thing is the right thing. I think it's to do with you being able to use it better than I can, and your size, in the case of Intuit, might be an advantage in that sort of situation. You might be able to go and acquire something that you can't.
It's an interesting argument from Buffett there, because the flip side of that is, like, he bought See's Candies back in the day, and yes, that doesn't produce a meaningful amount to the bottom line of Berkshire Hathaway, but if you had 10 See's Candies, it would. So I've never understood why Berkshire doesn't really want to... they don't do anything to these companies. They're just out looking for good management to run these businesses themselves and report to them once a year, and they're pretty much left to do their own thing. So I've never fully understood that argument from Buffett. I get that he thinks his time is valuable and therefore he should maybe just buy the companies that will provide the returns that move the needle, but 10 small companies is as good as one medium-sized company in my eyes, and they've been very, very good at buying these sort of companies and teaching them how to make money.
So we mentioned dividends and we mentioned Buffett. Do you have anything you want to finish on with Intuit before we move on to stocks with Paul?
No, that was it from Intuit.